When the coronavirus lockdowns came, many people feared the worst for the economy, remembering the bank failures of the 2008 Great Recession. But now, nearly 8 months into the pandemic, we have yet to see the same numbers of bank failures, and while the economy is still in a recession, the recovery has been significantly quicker. So what exactly is different this time? Well, for starters, the banks weren't the cause of the crash. The 2008 recession was the result of a bubble in the housing market bursting. In a bubble, the price of an asset will expand far past its inherent value, and once it reaches a point that everyone realizes this discrepancy, prices come crashing down along with everything that was dependent on those prices being high. In the early 2000s, commercial and investment banks got very comfortable with taking a big risk. That is, they bought a lot of assets using debt instead of their own cash. In essence, the ratio of what they owed to what they owned was growing very large. When the bubble on housing burst, the loans that banks had bought lost a huge amount of value. Very quickly, many banks were left with worthless assets that even if they managed to sell off, would not cover the costs of the debts they owed. This is why so many banks went insolvent in 2008. Today, there are some big differences in the way banks operate compared to before the Great Recession. In 2010, Congress passed an important act to better prepare the economy for a recession, the Dodd-Frank Act. The act established new government agencies and regulations to keep a better watch over the U.S. financial system that encouraged financial stability and discouraged risk. One part of it, the Volcker Rule, restricts the ways that banks can trade and invest, and makes sure that before they do, they have more skin in the game. That is, they were willing to risk more of their own funds rather than those of debtors. Another reason was the vast amount of excess reserves they started keeping after the 2008 recession. Before 2008, banks didn't have an incentive to keep high excess reserves because they could make more money loaning them out than just having them sit there. But as a part of the Emergency Economic Stabilization Act passed by Congress in 2008, the Fed began paying interest to banks on their excess reserves, which has in part contributed to the unprecedentedly massive increase that banks have been holding in recent years. These factors have kept the banks much healthier and less risky in the years leading up to the coronavirus pandemic, and we can see how it has paid off in keeping them above water during this extraordinary recession. Thanks for watching.